this is also a work in progress that I'm doing with Luigi Gioia, Young Research in Sant'Anna. And instead of simply adding a question mark, we changed the first part of the title, because I think that this sentence, the market power of ESG index providers, is more clearly examining the aim of this paper, that starts from the picture of growing impact of ESG investing all over the world, in North America and in Europe in particular. And so there is also some expectation of a further increase in this market values of ESG investing. And the reasons behind this quite impressive growth lying in, of course, the search of long-term financial performance and sustainability in the long run, brand and reputation of asset managers that try to anyway respond to some investment desire by individual investors, risk management practices, and also the pressure of regulation, and ethical motives, and also the social and the stakeholder pressure. So all these motives are quite important, and probably will drive also investment in the future. So anyway, the picture is quite complex, because the regulation, as we already heard some minutes before, it's quite complex. It determines a lot of costs for firms in Europe in particular. And there is a quite important also growing criticisms about the strong impact of a ESG perspective on financial investments. Some asset owners says that are not so happy with the logics of asset ESG indices, and sometimes also the assignment of ESG ratings are quite, as I will say later, is criticized and not so clearly related to the characteristic of the firm. This is not objective. And also from the governance point of view, in US in particular, some decision against the a strong orientation towards the ESG perspective are has been put in place. And so the problem, of course, emerges from the information asymmetry that is behind the estimation of the ESG characteristic of the firm, and in terms of environmental, social, and governance characteristics. There are some problems that are anyway addressed by regulation, but also some a huge impact of subjective evaluation exists, and it affects ESG rating, also the composition of ESG indices. That is very important, as we will see, for investment decision, in informing in general terms all stakeholders, but also in determining the investment of asset managers, in particular for passive investments. And so this is a picture about the market, about the value in ESG data. It increased quite significantly, and here also the value in terms of revenue growth for a market index provider. This is a fast-growing market, and is also very, very concentrated. So there is a huge and important power in these a number of index providers, information providers. And in this, of course, situation, some criticism emerges, because this power, okay, seems able to determine a strong impact in the investment decision. And also, as already said, the impact of passive investing increased a lot. And in 2019, for example, for the first time, money invested through the passive investment were higher than the active funds. And in this situation, of course, some agency conflicts and problems could emerge. This is an event in which insider trading has been identified according to the diffusion of the use of information about the change in an index, and so of course this could determine some power for index information providers, and we focus exactly on the effect of the inclusion and exclusion of individual firms for the index and how this could affect the market dynamics. Okay, the mechanisms that determine this impact is quite complex because listed companies, of course, give information to market participants, in particular ESG rating providers, and index providers takes the information and use it in order to change the composition of the indices. And so market participants take into account the characteristics of this index, and for passive asset managers and also active asset managers, of course, they invest their money to the listed companies. And of course, the problem is that behind the ESG ratings, there is a quite huge variability and also heterogeneity. This paper commented about how the correlation between different ESG rating providers is not so high, sometimes surprisingly low. And of course, it determines some huge important subjectivity in the definition of the ESG profile of the firm, and also market power in the firms that decide who is good or bad according to this ESG ratings. This is a post from Elon Musk that say, okay, this is a problem because this is nothing connected to the real ESG characteristic of the firm. Of course, I'm not saying that this is correct, but there is a quite heavy debate on that. Okay, this is the empirical part of our paper. We consider the MSCI indices. We collected data for 11 indices from 2011 until to the end of 2021, and we had more than 4,600 unique events of addition and exclusion of firms from the indexes, and so we tried to understand if this determine a market impact in terms of informational value, or also rebalancing for the determined by passive investors, and also if there are differences according to the characteristic of the firm. For example, if they are located in developed or emerging markets, and as we will see later. Okay, so we try to interpret this general result, taking into account the specific characteristic of the firms. And the last part is about the impact on firms' ownership, because of course we are interested in understanding what is the reaction, not only in terms of returns and abnormal volumes, but also if the ownership of investors, strategic investors, long and short-term financial investors could change according to this different positioning of the firm within the index, the ESG index. Okay, so I don't want to, of course, to go too much into specific details, but we used two measures of abnormal volumes and abnormal returns in order to understand if there is a significant impact of the release of this information of the market. This is the methodology is the event study, the standard event study methodology, but we have two events quite closely positioned to time. This is the first one is the AD, the announcement date in which the index provider says that the firm will enter or exit from the index, and this is the effective change date in which the firm exactly enters or exits from the index. And in the event window, we consider some days before, the days between these two events, and also some days after the effective change date. Okay, we found some relevant impact of changes in the index composition. The first is about abnormal trading volumes. You see here that around, in particular, as expected, the exchange date, okay, we have, this is a abnormal volume measure. 0 means that the volume is as usual, okay? After the adjustment for the general changes in volume of the market, 0 is everything is standard and normal. We see that these lines are all above 0. So it means that around this event, some over volume exists, but in particular here for around in the day of the rebalancing of the index, it's quite significant. And we see that this is stronger for the end. End means the exit from the index, and it exists, but it's lower in terms of abnormal volume for the entrance within the index. So we could interpret, of course, some within the framework of the negativity bias. So anyway, this is anyway a matter of fact that there is this quite strong impact on market volumes. Okay, this is some statistics about the statistical power of these numbers. This is quite strongly statistically significant. So I will go on and skip that. And this is about the market reaction in terms of abnormal return. We can see here that around the announcement date, we don't have usually a strong impact, but we have a huge positive and negative impact that sometimes is also followed by a period of recover of normal values around the effective changes date. Okay, so it means probably that there is this is the impact of the rebalancing effect. And but anyway, after this is not strongly consistent with, of course, a market efficiency, but we can see even if there is no immediate and clear reaction in terms of excess returns, we can see that in the whole windows around the 30 days, there is a quite significant differences in returns for firms included or excluded from the index. Okay, time passes very, very fast, so you have to run in order to let you see what's next. Okay, now we made some checks in order to understand if results changes about the characteristic of the firms. For example, we consider heavy polluting versus cleaner industries, and we can see that the impact for heavy polluting, this is the more solid lines that are added here, okay, are generally lower in terms of market evaluation than cleaner. Okay, so it could signal, okay, a negative impact in general, a more negative impact in general terms of firms in the heavy polluting sectors. And this is the comparison between emerging and the developed markets. This is the picture for the developed markets. And this is, as you can see, for the emerging markets is much more volatile and also with some stronger impact. And you can see this also for volume, okay, for the developed and on the left side, emerging markets. SRI versus non-SRI firms, okay, I will skip that. Simply, this is a multivariate regression because we had here an attempt. We try to interpret if the abnormal return are connected to some specific characteristic. We see here, for example, that this Paris agreement, this is a dummy that says that this change in the index are the after the Paris agreement, okay? And so we can see that the market impact is higher in more recent years, okay? And so we also try to consider different characteristics in terms of emerging market, the ESG ratings, and so I have to stop, of course. And this is the last chart, okay? This is the impact in terms of ownership. In particular, I'm consider this one. We see here that long-term financial and short-term financial investors are quite significantly affected in terms of ownership of each individual firm by the decision of exit or entrance in the index. And in particular, you can see here long-term investors reduces after the exit from the index. That's it.